Well, U.S. stocks just closed out 3 straight years of blockbuster gains. The S&P 500 ended last year up 16%, the Nasdaq jumping 19%, and the Dow rising 13%, despite a modest dip in the final trading session of last year. Now, Wall Street is asking the big question, can this rally keep going in 2026? Well, joining me to weigh in this morning is David Traynor, CEO of investment research firm New Constructs. David, good morning. Thank you so much for joining me. Happy New Year. Well, after such a strong run for stocks in 2025, do you think markets are entering 2026 priced for perfection or not?
Hi, Remy. Yes, happy New Year to you too. And I do think so. I think a lot of stocks are really expensive, and this is going to be a year of discernment, where markets are going to really start to parse out who's got the money and who doesn't. And we saw that happen near the end of 2025 when stocks like Oracle and CoreWeave really got crushed because they just didn't have the cash flow to keep up. They didn't really have the underlying strong margins and economics that some of these bigger winners have. And I think we're going to see more of that happening in 2026 because the pressure to spend to keep up in the AI race is just enormous.
Yeah, so building on what you just said, David, does 2026 mark the end of easy gains from big tech and AI and the beginning of a more selective market? And while I have you here, CES is underway in Las Vegas, so we'll be keeping a close eye on those big AI names and any announcements. So tell us what you're looking forward to as we head into 2026.
Yeah, I'm looking forward to seeing markets again be a little more careful and not just sort of glazing every single stock and every single AI related company. You know, we've seen this happen so many times. It happened in the internet bubble that anything related to internet got a boost. And we saw this with blockchain. You know, all you had to do was put blockchain in the name of your company and you got a stock price boost. And I think that's been going on for so long, along with meme stocks, that people I think are really starting to recognize that look, it's just not that easy. It's not going to be that easy. And I think another big trend that people are missing is that the betting markets are now offloading some of the sort of pure speculative energy that has driven so much of the animal spirits in the stock market. And so, as more people find more entertaining things to bet on, you know, whether it's sports or how many times Trump will point at the camera in a given interview, stock market investing is going to get back to more of what it used to be, which is about capital allocation and not betting and speculation and entertainment. And in that environment, I think markets will be more discerning and more focused on cash flows, competitive advantage, the expectations baked into the stock prices, the things that investing are about, and not so much about speculation.
Yeah, and while I have you here, David, you mentioned a lot of key points, especially when it comes to AI. So tell us whether or not you think we're in an AI bubble and how soon we start seeing clear winners and losers. And if you could tell us what that actually looks like.
So I think I want to first of all be careful not to get caught into this sort of dichotomy of like, well, are we in an AI bubble or do you believe in AI? Because I think both can be true. And I think I do believe that both are true. And I think we are in an AI bubble in some stocks, but not other stocks. Like I was saying in the beginning, some of them have got the cash flows and the abilities to continue to compete, but some don't. And I think that's where the discernment comes in. And I think we're not necessarily in a sort of super huge broad market bubble like we were back in the internet days, but we are in what I would call there are going to be what I call micro bubbles, where there are groups of stocks that are dramatically overpriced, and you're going to see them get crushed at times, while other stocks will be able to hold up. So I think that's a big part of the theme. And I also think that to the other part of your question, AI is here. It is real. It's going to make real impact, and it's this next sort of innovative or technological wave that's happening even faster than every other prior wave, and we see this continue to accelerate. And so the AI effect is real. It will improve productivity. It will improve lives. It will change lives. It will change companies. But not every company is going to benefit from that. So much of the benefit of AI is going to accrue to the consumers. And it's not all going to accrue to a bunch of big companies or the stock market. That's what innovation, real innovation is over the long term. We saw that play out with prior levels of innovation as well. So I think it's a more nuanced answer, Remy, than maybe what you're looking for. I think we are in a bubble in some spots, but we're still in an AI boom in others.
And finally, David, before I let you go, I want you to expand on why cash flow matters more than ever, especially when it comes to the winners in 2026.
I think this is for me, it's a really kind of an interesting trend where this enormous amount of spending in AI, billions of dollars per month, has really become the new table stakes. Like it's like a being at a poker game and the ante just gets higher and higher. The ante is now so high that companies looking to be in the AI race, Oracle's a great example, the poster child of a piece we wrote back in November saying, hey, listen, the winners and losers in the AI race, it's going to be primarily about cash flow. And cash flow has got to be huge in order to keep up with this 20, $30 billion per month spending on AI. And there are only a few companies in the world that can do that. Those are the winners. Everyone else is likely to be a loser unless they get lucky, hit a home run, hire some right person. Another good example of sort of the struggle to keep up in the AI race is Meta, right? And we see Zuckerberg taking these $100 million swings, trying to land this great talent, and he's having a hard time keeping him. And as much as he's been sort of part of the big popular companies, part of the FANG for a long time, Microsoft or Meta doesn't quite have the cash flows to keep up with the big boys. And so we're going to really start to see, that's the next one I think that might fall out of bed here. We're going to really start to see who can keep up, who can't, who can run with the big dogs and who can't. And when I say big dogs, I mean big cash flows.
Well, David, we will have to leave it there, but thank you so much for joining us today, and thank you so much for sharing all of your insights.
Thank you. It was great.